Hello, and thank you for tuning in to another discussion of Introduction to Financial Accounting. Today, we're going to continue to discuss accounting for a merchandising operation. However, in this video, we're going to look at the purchaser side of the transactions. So, by the time you complete this video, hopefully, you should be able to define what a purchase return is. You should be able to define what a purchase allowance is, and you should be able to define what a purchase discount is. You should be able to prepare proper journal entries that account for purchase returns as well as purchase discounts. And you should be able to determine who pays the shipping cost. So the first thing we need to kind of cover is the definitions, right? What exactly is a purchase returns and allowance account? What is a purchase discount account? How do these differ? Well, the first thing we need to recognize is that all of these three things that we have all pertain to the purchaser, right? If you remember in our previous video, we talked about the merchandising operation and we talked about what a merchandiser does. So in this video, we're going a little deeper. We're looking specifically at a merchandiser who is purchasing merchandise from a wholesaler. They're increasing their inventory. When they buy from a wholesaler, there may be something wrong with the shipment or the merchandise that they receive. They may receive defective merchandise. It might be unsatisfactory for some reason. Okay, maybe it's the wrong color, maybe it's the wrong, or maybe it's just it's broke. So there's going to be a reason that we would want to return something. So purchase returns is when the buyer sends back any unsatisfactory merchandise to the seller and they receive a credit. Okay, when we say credit, don't get confused with the debits and the credits that we've been talking about. What we're saying is they receive a reduction in the purchase invoice, okay? Let's say that Target orders makeup from a wholesaler. That makeup comes into Target. They open up the shipment, they receive it, and they notice that all the makeup that they ordered is ruined, right? Maybe it sat out in the hot sun and it melted or something. Target contacts their wholesaler and basically Target says, hey, this merchandise is defective. We do not want it. We are sending it back to you. We want to receive credit on our purchase invoice, meaning we don't owe you as much as the purchase invoice says. Why? Because we returned that merchandise. So purchase returns can come either because the merchandise is defective, or maybe it's just unsatisfactory. Maybe the wholesaler sent the wrong brand or sent the wrong color. Okay. Now, a purchase allowance, which is totally different from a purchase return, kind of happens under the same scenario. Okay. Let's use that Target example. Target orders makeup from, I don't know, whoever they order makeup from, Revlon or whatever. Anyways, so let's say that they get the order in. Target opens up the shipment and they say, you know what? Revlon sent us the wrong color. We didn't order ruby red. We ordered, strawberry red, whatever. So what happens is Target calls Revlon and they say, hey, you sent us the wrong color. We didn't order this. Revlon says, okay, we're sorry about that. Revlon says, Revlon's smart. And they say, hey, Target, if I gave you a discount on that ruby red lipstick that you really didn't order, would you be willing to keep it? Target thinks about it and says, yeah, we could probably sell it even though we didn't order it. I'm sure somebody would, one of our customers would want to buy it. Sure, we are willing to keep this unsatisfactory merchandise if you reduce the price. That's exactly what happened, okay? That's an example of a purchase allowance. Now, purchase discounts. These only apply when we have credit terms to a sale, and they only apply when we pay the invoice within that credit period. So basically, the purchase discount is the cash discount that is received by the purchaser for paying the invoice within that discounted period. If you remember in our last video, we talked about 210 net 30. You pay it within 10 days. We as the wholesaler will allow you, the purchaser, to take a 2% discount on your invoice price. So I know we covered this in the last video. I just kind of wanted to dive a little deeper. So when we're talking about purchase discounts, remember it comes with a discounted percentage, 2%. It comes with a discount period. That discount period is usually in days. You may see 10 days, you may see 15 days, you may see 30 days. It's all different. It's all based on what the seller wants to offer. Okay? The N stands for net. Basically, what we're saying here is if you don't pay within 10 days to receive that discount, we want the net balance within 30 days. So what is the net? The net is the sales price, or the total sales price that is on our purchase inventory, less any returns and allowances. That's the net. So now we need to look at who pays shipping, right? Does the buyer pay it? Does the seller pay it? Does it differ? Well, yeah, it does. It all depends on what the terms are of the order. So we have what we call free on board. So there's two FOB points, so to speak, that we're going to use. It's either going to be FOB shipping point or FOB destination. What both of these definitions tell us is that it tells us A, who pays the shipping cost, and B, when does ownership of that merchandise change hands? Meaning, when the ownership changes, I sell something, somebody else takes possession of it. When exactly does ownership change? Well, that depends on if it's FOB shipping point or FOB destination. So let's look at FOB shipping point. FOB shipping point says that the buyer or the purchaser is responsible for the shipping cost. That means they pay for the shipping cost. When does ownership transfer? Well, under FOB shipping point, ownership is assumed by the buyer when the merchandise is shipped. Okay, so let's think about that. Let's go back to our Revlon Target example, right? Target buys merchandise from Revlon so they could turn around and sell it. Revlon says, okay, we'll sell you, X amount of lipstick and makeup and rouge and whatever else. We're going to ship it to you, but this order is going to be FOB shipping point. That means that Target, since they are the buyer, they have to pay for the shipping cost. And Target assumes ownership of that merchandise as soon as Revlon ships it. So that means that while it's in transit, so let's say that Revlon contracts with UPS to ship their merchandise. Once UPS picks up that merchandise from Revlon, guess who owns it? Target, because it's FOB shipping point. So that means if anything happens in transport from the Revlon wholesaler to the Target store, Target owns that merchandise. They are responsible for it. If it's lost, damaged, whatever, Target's going to take the hit. Now, FOB destination says that the seller pays the shipping cost. Okay? When does ownership change when we're talking about FOB destination? Well, ownership is retained by the seller as the merchandise is in transit, meaning ownership only changes hands when that merchandise is delivered to the buyer. So let's say we have FOB destination with this Revlon Target order. Revlon calls UPS, says, hey, we got a package here. We need you to deliver the shipment to UPS, or need you to deliver it to Target. Revlon has to pay UPS to ship it, and while UPS is transporting that shipment to Target, guess who owns it? Revlon. Target does not take ownership of that merchandise until Target receives the merchandise, until it's delivered to them. This will become very important if you get into any advanced financial accounting classes. When we do audits and we're counting inventory, we need to take into account, is it FOB shipping point or FOB destination? That determines A, who owns the merchandise, and B, should we count that in their inventory or should we not? Okay? So let's look at an example of the purchaser side of the transaction. Okay? Let's assume Charlie Brown Corp. Purchases $50,000 of merchandise from Woodstock Incorporated. Terms are 210 net 30. So right off the bat, when you see terms 210 net 30, you automatically assume that Charlie Brown purchased this on account or on credit. Okay? The terms of this order are FOB shipping point, and the shipping cost was $1,000. Okay, so we are Charlie Brown in this. We're Charlie Brown Corporation. What do we need to do? Well, whenever we order the merchandise, we need to adjust our accounting records, right? We receive a purchase invoice. That purchase invoice says that we ordered $50,000 of merchandise from the Woodstock Incorporated. We have 210 net 30. The total purchase price of this invoice is $50,000 and it has FOB shipping. First thing we need to do is when we get that purchase invoice, we need to book the entry. This should be review. What do? Well, we are getting inventory, so our inventory has to increase. Inventory is an asset, so we have to debit inventory. Accounts payable. Accounts payable is a liability, right? Anytime we buy something on account, we use that accounts payable account. Accounts payable is a liability. How do we increase a liability? With a credit. So, this transaction on Charlie Brown Corp's books says that our inventory is going up by $50,000. Our accounts payable is also going up by $50,000. Notice we have an explanation here. Well, what did we do? Well, we bought merchandise on account, terms 210 net 30. We put that as the explanation, okay? So, let's assume that the shipment gets delivered to us, right? We have the purchase invoice. We have to pay for the shipping cost. We are Charlie Brown Company. This order was shipped FOB shipping point. FOB shipping point dictates that what? The buyer pays the shipping cost. So what we need to do is book this second entry here. This second entry says that we need to increase our inventory by $1,000 and we decrease cash by $1,000. Now let's think about this for a minute. We are paying for shipping, right? Why don't we just use shipping cost or shipping expense and just pay it with cash? Well, we need to realize that when we are determining our inventory value, the value of inventory is determined by a number of things. First, it's determined by how much do we pay for the merchandise? Well, we paid $50,000 for it. Merchandise is increased, or the value of merchandise is increased by B, shipping cost, and C, any costs we incur to get that merchandise ready for sale. Okay? So keep that in mind. When we have these, these shipping costs and we're the buyer and it's FOB shipping point, that cost increases the value of our inventory. So that's why we are debiting inventory and crediting cash. So we basically paid wrote UPS a check for $1,000, said, hey, thanks for the delivery. We need to recognize it as the accountants for Charlie Brown Corporation. The shipping cost actually increases the value of our inventory. Okay. So let's say for a minute we get our shipment, we open it up, we start counting and making sure everything's in there. We compare it to the purchase invoice, and we discover that $3,000 of the merchandise ordered was damaged. Okay, that merchandise came in and it was broke. We just couldn't sell it because it was broke, it was damaged, it was defective. So we call Woodstock and we say, hey, $3,000 of this merchandise, it's damaged, it's defective. We don't want it. We are sending it back to you. We want credit, meaning we want you to reduce the amount of money that we owe you. We ordered $50,000 worth of merchandise. We are returning $3,000 of that merchandise. $3,000 of that merchandise back to you. Why? Because it's defective. It's broken. Okay. Woodstock says, sure, no problem. Send it back to us. We need to adjust this. Well, let's think what we're doing here, right? We are returning merchandise, so we don't have that inventory. Our inventory is decreasing. Inventory is an asset. How do we decrease an asset? We decrease an asset with a credit. Great. Well, we bought this merchandise on account. It was a credit sale. We owe somebody money. The merchandise that we got, again, was defective. We can't sell it. We don't want it. We're sending it back to them. So guess what? We owe them less now. So we're going to decrease our accounts payable by $3,000. Accounts payable is a liability. How do we decrease a liability? With a debit. So whenever we send back merchandise or we return merchandise to the wholesaler, we always have to debit accounts payable, credit inventory. We are decreasing the amount that we owe them, and we are decreasing our inventory. Okay? Now, let's say as we continue to go through this inventory, we see that $1,000 of this merchandise was the wrong color, right? We ordered canary yellow. They sent us forest green, right? Of whatever the merchandise is. Well, it's the wrong color. We don't want it. So we contact Woodstock and we say, hey, Woodstock, you know, we wanted canary yellow. You sent us forest green widgets. We don't want this. Woodstock says, okay, Charlie, would you be willing to keep that merchandise if I reduce the price by 50%? So we're business people here and we say, hey, you know what? Even though it's hunter green or forest green, somebody will probably end up buying it. It's worth it for us to keep this at a discount. So we say, hey, you know what, Woodstock? Sure, we'll do that. We'll keep this merchandise as long as you reduce the price. Woodstock says, no problem, it's done. So what are we doing here? Well, we're keeping the merchandise, right? But we're not paying the full amount for it. We're receiving a 50% discount on this on this wrong colored merchandise just to keep it, okay? So what are we doing here? Well, this is identical to the purchase return that we just did. The only difference is we're keeping the merchandise, okay? We're still keeping those physical units. However, the cost of those physical units are decreasing. So we're going to credit inventory for $500. That's the allowance that we received for keeping this wrong colored merchandise. And we also need to decrease our accounts payable. Why? Because we don't owe Woodstock $1,000 for this damaged merchandise or wrong colored merchandise. We now owe them $500. So our accounts payable are decreasing by $500. Our inventory is also decreasing by $500. Again, what's an accounts payable? What's a liability account? How do I decrease a liability account? With a debit. And then if you notice the explanation here says that, hey, this is the allowance we received for the wrong color of inventory. Okay, so we have basically two things that happened, or three things. We ordered merchandise for $50,000. Upon inspection, $3,000 of that merchandise inventory was defective. We sent it back. In addition to that, $1,000 of the merchandise was the wrong color, but we received an allowance because we said we would keep that merchandise at a discounted price. Okay? So now, Charlie needs to pay Woodstock. How much does Charlie owe? If you look here on the slides, we have our T accounts, right? So let's notice what we did here. If you notice, we have the inventory debit of $50,000. That represents the initial purchase. We have a credit to accounts payable for $50,000. Again, that establishes the fact that we bought inventory. We owe Woodstock $50,000. Then we have our returns. What do we do to return that $3,000 worth of merchandise? Well, we credited inventory, debited accounts payable. Then we looked and we said, okay, some of this merchandise is the wrong color. We call Woodstock. They say, hey, we'll give you a 50% discount if you keep it. Great, we'll do that. So then, in addition, we decrease our inventory by $500 with a debit. We also decrease the accounts payable with the $500 debit to accounts payable. That's the allowance. So what's the balance? Well, the balance of this purchase invoice now, after the returns, after the allowances, is $46,500. So we see that our inventory balance is $46,500, which matches our accounts payable that we owe Woodstock, $46,500. So now let's go ahead and let's pay Woodstock. Well, remember, we have two scenarios under which we could pay Woodstock. We could pay them within 10 days because remember, on our purchase invoice, we had 210 net 30. Woodstock is enticing us to pay them quicker. Or we could forego the discount and just pay the net within 30 days. So let's assume in this assumption that we in fact do take the discount. We pay Woodstock within 10 days. Okay, what do we have to do? Well, we have to decrease our liability. We have to decrease our asset, which is cash because we're paying cash. And then we have that discount we need to worry about. Well, since we are the purchaser, that discount is accounted for in our inventory account. So because we're taking a discount, that means our inventory is cheaper. We have to then decrease our inventory for $9,300. Excuse me. So notice what we're crediting, notice what we're debiting. We're debiting accounts payable for $46,500. Why? We as Charlie Brown don't owe Woodstock $46,500. We're taking this discount. We owe them $45,570. So why are we debiting accounts payable for $46,500? Because that is the balance of the accounts payable. We have to get it off the books for the amount that it's on the books for. It's on the books for $46,500. If we get it off the books for anything less, guess what? Our accounts payable is still going to show that we owe Woodstock that discount. So we always take the accounts, or we always debit the accounts payable for the amount that is on our books. Okay? That's number one. So we got rid of our accounts payable. We now do not owe Woodstock $46,500. Right? We got a discount. 2% of the amount that we owe them. Well, how much did we owe them? $46,500. We multiply that by 2%, we get $930. That discount, that's the discount that we're taking for paying early. We account for that in our inventory account. So that discount is decreasing the value of our inventory. We're going to debit inventory for $930, or I'm sorry, we're going to credit inventory $930 to decrease it. And then we're going to decrease our cash for the invoice price minus the discount, which is $45,570. This is the journal entry you need to make whenever a buyer pays for merchandise within the discount period. Now, let's assume for a moment that Charlie Brown pays a purchase invoice from Woodstock, but it's not within that discounted period, right? We paid within 30 days. We're past the 10, but we're within the 30 days. Let's say on day 30 days after the order, we say, okay, now we're going to pay Woodstock. What does that journal entry look like? Well, we debit accounts payable for $46,500. We credit cash for $46,500. And that is the purchaser side of the transactions. Now, if I were you and I was studying this and I had to learn this, I would go back and I would turn a number of these slides into note cards, right? I would definitely make sure that I knew what purchase returns were, purchases allowance, and purchase discounts were. I would make sure that I thoroughly understood what each of the elements within the terms mean. 2, 10, net 30. What's the 2 mean? Well, it means the first term within this is always going to be the discount percentage. Then it's always going to be the discount period in days. The net is sales price less any returns and allowances, and then the credit period. I would know what FOB shipping point is and what FOB destination is. I would know the examples of how do I book a purchase on account for inventory. Well, it's right there. What do I do with FOB shipping point? How do I account for shipping? If it's FOB shipping and I'm the buyer, well, I account for that cost of shipping in the inventory. It changes my inventory value. I would know how to book a purchase return and what exactly is a purchase return. I would know how to book a purchase allowance. I would know how to account for the inventory balance and the accounts payable balance when we have returns and allowances. I would also know how to book a journal entry for paying a purchase invoice within the discount period, and also how to count for that discount period. Remember, that discount always decreases inventory. And then, how do I book purchasing or paying a purchase invoice outside of that discount period? Okay. When we come back in our second video, we're going to look at what does the seller side of these transactions look like. So we're going to look at the same example and we're going to demonstrate that through the purchaser side. So tune back in for that.